Hi there and welcome. Mike Williams with Genesis, and we're sure glad you're here today for this quick lesson. This piece we call the short seller's nightmare. Now, a lot of investors aren't often aware that there are multiple actions going on at any one point in time in any number of stocks. We're going to tell you a story today about short selling. Now, again, these are just mechanical oversights. This isn't designed as investment advice or anything like that, nor are we covering every single minute detail. That would take hours, and you're not going to sit around that long. But what we wanted to tell you about is things like what's a short squeeze, what's it look like, why does it happen, and why does it end? So let's talk through the mechanics. Often people think that when someone sells a stock, it simply means they no longer own it, and they owned it before, and they watched it go up or down, and they got rid of it. Well, certainly there are buyers and sellers, and the sellers do that. But sometimes the seller is someone who never owned the stock to begin with. He had to borrow the stock. Now, what does that mean? If I want to sell short a stock, the first thing I have to do is I have to go find one of the Wall Street houses who happen to have some of that stock on inventory and are willing to lend it to me so that I can sell it short. Now, why would I sell something short that I don't own? For one purpose and one purpose only. I think it's going to go down in price, so that if I sell XYZ for $100 and it goes to $50, I buy it back for $50, I pay off my loan, and I get to keep the difference between $100 where I sold it short and the $50 where I bought it back. That's all when things work perfectly. We've tried to draw a little piece on the chart here. I'm going to kind of go over some of these things on the board. Forgive, this is hand-drawn. This isn't done by a professional. It's done by me, and I'm a terrible drawer. So we talked about borrowing the shares. So a short seller here has to borrow shares. So the Wall Street house lends him the shares. It's like a loan. I really have to pay cost. Depending on how many others want to borrow that stock, it might be expensive to borrow that stock. It's all supply and demand. When you see a stock that is, quote, heavily shorted or has a high short interest, that means a whole lot of these guys have borrowed a whole lot of stock and they now owe it back at some point in time. Now, ideally, if I sell XYZ short here on the chart, then I'm looking for it to fall. In other words, I want it to go down. And if and as it does, I am in a profit. However, sometimes it doesn't work out that way. And instead of going down, the stock I have sold short continues to go up. So when I hit my line of where I have sold short, back here, proverbially speaking, then what happens is this starts costing me money. So not only do I owe whatever the cost is to borrow the things that I've sold, I now lose money every time it goes up in price. So as this kind of unfolds here, the pressure on short sellers is expanding. It's increasing because every dollar it rises, they're further underwater. And what we call a short squeeze is often on a chart, you will see something where the stock price literally goes straight up the chart over a fairly short period of days. This is what we call a short squeeze. What does that mean? All the shorts, remember, they have to buy that stock back. They have to. They don't have a choice. They have to pay the loan off. Stocks can go to the sky. They can go to $1,000 a share. They can go to higher. They can only go to zero. So remember, if I'm an owner of stock, I have a limited amount of money I can lose. I can lose to zero. If I'm short at $100, I can lose to 1,000. I can lose for as long as that stock will go up. So it's a very risky bet. That's why they're far more emotional when it gets a squeeze. because this costs a fortune if you are short the stock. Not only do you owe all this money back, but you got to pay back the mortgage that you've borrowed, and that's an interest rate. It's like walking to a bank and saying, I sold my house for $100,000. And the bank says, great, move out, but your mortgage was $300,000, so write me a check for the other $200,000. So you can kind of get a picture of what it feels like when you're in a short squeeze. So what does this look like? It goes straight up the chart. The shorts are squeezed out. They are forced buyers. They must buy, and they're typically doing it in a frantic mode. That's why the chart looks like this. That's why price action just starts jaunting upward. Now here's the thing. When it's all over, when that forced channel of buyers have left, when all those shorts have covered, when everybody who wants to get out is out, here's what the stock does. It typically kind of just rolls back over. But that squeeze is that big spike in the chart. It looks like a little mountain crest on a chart when you look at pictures of what stocks do. So, what does all this mean? It means that if you think about short selling, it is far more risky than owning stocks. You have to be a real expert at it. Some are very good at what they do. But listen, you have to do it based on research. You have to understand something fundamentally wrong with the company. And to give you an example of something like that, I'm going to show you a very recent story. Many may recall that in recent weeks, Lumber Liquidators has been a stock that the short sellers had a heyday with. Now, the gentleman that actually started the process of understanding that Lumber Liquidators might be overpriced. And if you'll take a moment and look at Lumber Liquidators stock, you'll kind of understand what I mean. But there was a hint in why you would sell that stock short. Now, again, I'm not suggesting you go out and look for ways to sell stock short, because it's a very risky business, and only the best analysts are good at it. But here's how, and I'm trying to give you an example of why a stock would crumble under that pressure. If you and I were researching stocks, and our analyst team pointed out what was pointed out about Lumber Liquidators, that's why we would start investigating. Let me give you a little feedback of how that happened. Lumber Liquidators sells wood. Now, in this particular case, and I have no knowledge, I'm only reporting what the public data has suggested, they had apparently, and this was on 60 Minutes, apparently very high margins, higher than all other companies who sold lumber for a living. So when you're looking at analysis and you're saying, why in the world would that particular company have higher margins than all the other guys that sell the same stuff? So that's the tidbit that caused people to start peeling the onion back in the financials. So we've all seen things unfold now in this particular story. We saw it on 60 Minutes. We saw the aftermath of the short sellers. And this is an example of a stock that actually did work for short sellers. It plummeted to earth once the inaccuracies were covered. But again, I'm not trying to say right or wrong. I'm simply trying to give you an example of how short sellers think through a process, and how they might find opportunities to, in fact, sell short. But again, I want you to remember, the purpose of this particular lesson was about the short seller's nightmare, and that is when things don't go right. When you are short a stock, the losses can mount to significant levels, and it can be very fast and very tough on a portfolio. So make sure you check with your advisor. Again, this is a lesson about how the mechanics unfold. We hope you've enjoyed it. We hope it adds some value, and we'll see you again on the next lesson. Thanks very much.